Hi everybody, and welcome back to our last video, number 6. And when we left off, we were looking at reversing entries. And I mentioned that we would never think about not for doing a reversing entry, not using a reversing entry. And here's why. Just think of what it takes to be able to calculate this accrual. You have to go in for all your hourly people, your semi-monthly people, your hourly people. You have to do all your adjustments for um, shift differential and overtime and all that. It's a very complex and time-consuming piece of work. Now, how would you like to do it again in the next month, which is shown here? This is what this is, that you would have to recalculate this again, and then you'd have to make sure that this $2,500 here was reconciled. Say you made a mistake up here, this would be or a mistake here, this would not agree to what you actually paid in cash, which was the $2,500. So the reversing entry eliminates all those problems. And as you see here, you only need to just simply do a reversing entry here, which is the reverse of this here, right? And away you go, you're done. But I think you need to think that through a little bit before you'll totally understand it. Okay, so if I compare those entries, in this case, we're going to use for deferrals. Um, we initially purchased some supplies here and we close those out. So the reversing entry then would, um, um, we would debit supplies expense and credit supplies here for 5,000, which is the opposite of this here. See how that works? Okay. The difference is that here we debited supplies and credited supplies expense. That was the adjusting entry. Whereas here we debited supplies expense and credited supplies. Okay. Typically, though, I don't do this one in the real world. A little more difficulty than the benefit you get from it. All right, so let's take a look at the accounting cycle revisited. We're going to prepare this worksheet here. The company prepares a worksheet using columnar paper like we used to use in the old days, or with a computer spreadsheet like Excel, which I use frequently. So a company uses a worksheet to adjust account balances and prepare its financial statements. And the worksheet columns would include our trial balance adjustments, adjusted trial balance, income statement, and balance sheet. And here is our, I think that's a 10-column spreadsheet here with all that included in debit and credit forms. Our unadjusted trial balance, our adjusting entries, adjusted trial balance, income statement, and balance sheet. And how we do that down here at the bottom, how we get our net income and how we adjust these totals so that the income statement and the balance sheets totals agree. Okay, now items alpha through golf below serve as the basis for those adjusting entries. So we have some depreciation, we have some bad debts based on an aging of accounts receivable. Now, whenever you have an aging of accounts receivable, that's a receivables method, and you do need to consider the existing balance on the allowance for doubtful accounts when you have a receivables method. If you have a sales method, you don't need to. And then here we have some expired insurance. That means that insurance has been used up. So that's going to be your insurance expense here. And then we accrue some interest on the notes receivable for $800. That'll be interest expense. And then right now, the rent expense contains a $500 rent paid in advance, which is applicable to next year. Okay, we'll have to fix that. And then property tax accrued for 2000, and then income taxes payable estimated at 33,440. All right, so let's take a look at GAAP and the international financial reporting standards. International companies, and I think there's 120 countries that use international. Here, only the United States uses GAAP. So we're trying to get to one statement of standards, and that's called convergence. But to date, they are two separate accounting systems, making it a little more difficult for our multinational companies to operate under the same plan here. So, all right. So, mostly though, they're the same. Journal entries, general ledger, they're the same under GAAP and IFRS. But you will see in later chapters there are different standpoints, different standards that sometimes impact the transactions that we record. The one big one, I think, is the one that I highlight, is that LIFO is not used for IASB, but we can use it for GAAP, prepared by the FASB, Financial Accounting Standards Board. Okay, so there are some more similarities here, and the trial balance under IFRS follows in the same format as shown in our textbook. So remember, from a presentation standpoint, you want your dollar signs typically to be used only in the trial balance and financial statements. Normally, when we do our journal entries, we don't use dollar signs. But the same practice we follow under IFRS, using, of course, the currency for the country in which that reporting company is headquartered. Okay, differences. Rules for accounting for specific events sometimes differ. European companies rely less on historical cost and more on the fair market value than the U.S. companies. And so despite those differences, we still use a double entry accounting system. Internal controls are a system of check and balances designed to prevent and detect fraud and errors and make more accurate reporting. While most companies have these systems in place, many have never completely documented them, nor had an independent auditor attest to that effectiveness. But they are required under SOX, and it's a big deal. I was the SOX coordinator in my last position, and we did over 100 audits in every quarter. And those audits, I had to analyze and see if we had to make any adjustments to our internal control processes. And then at the end of the year, an external auditor audited what I did to ensure that what I did met their standards. Very expensive SOX is, whereas under the other companies of the world don't need to do that. Okay, that ends our last video on this chapter. And when we return, we'll start on chapter 3. Until that time, bye for now.